Hello, and welcome back to another macro and flows update. Here we are at June OpEx tomorrow morning. And a big quarterly OpEx, as we've talked about for some time now, about a month and a half. We are amidst the summer of George. What is the summer of George? This coin term that I coined back in 2021. It is a time of volatility supply at the index level that forces massive dispersion amidst the constituents of the index, increased volatility because of the index being pinned. Essentially, if some constituents of the index go up and the index itself is very stable and just grinding higher, other constituents actually have to go down. And that's driving very, very poor breadth, something that everybody is talking about now. And it's also driving a wall of worry because everybody's worried about the breadth. What do we mean? Just 19% of U.S. stocks has managed to outperform the wider market in the last month. 19%. It's the worst breadth we've seen in over 20 years. But again, that's not a coincidence. That's now we can talk about whether that's unhealthy in the long term, which I believe it is. But in the short term, that is not a short-term sell signal. If anything, the worry that is coming as a function of that is driving even more of a grind higher. Some other interesting facts. It's been 35 trading sessions since we've had a daily loss of greater than 0.75% in the S&P 500. Again, that is the summer of George. It is a time of vol supply at the index level. We're having 4 times the volatility of the constituents of the index than to the index itself. Things are flying around, going in different directions, big moves of the constituents, almost no move at the index level. The index is not just an index of a mathematical calculation of what the single stocks are doing. The index itself is a major trading vehicle. It is bigger than the constituents trading at this point and having bigger effects on the constituents than the constituents are having on it, you can argue. So it is a push-pull, but primarily a push from the index down that is forcing underlying movement within the underlying constituents. So that is the biggest thing happening to markets. Otherwise, it is a very placid market. There is a lot of support to the market by fiscal policy, relatively stimulative monetary policy. Treasury itself is also being stimulative. So no problem from liquidity at this point from a macro perspective. And importantly, it's very important to note, when the market goes up reflexively, that creates more dollars and creates liquidity. It's some people call it the wealth effect. It's actually quite a bit more than just a wealth effect. It is a increase of collateral across the system, and the system being quite leveraged benefits from greater actual collateral to increase leverage even more. So it's essentially a form of money creation when assets go up, when the stock market goes up. So not surprisingly, we've had a continued grind higher. It's exactly what we've called for, and a vol supply issue forcing vol and the VIX low. We believe this will continue for another month and a half to 2 months. The date we've put on the board is August 15th or so. The Wednesday of expiration in August, that'll actually put us, August 14th, that'll put us in line for the beginning of the fall. So that is a time to start buying vol. It is also a time to start lightening up on some of the long delta exposure we've been looking at throughout this period. It is, again, we believe through the end of the year, this market will continue to perform well, but we do believe in that window coming in August, we'll likely start to get a real pullback of some kind and an increase in volatility. We believe that the last part of this rally, which will likely come in the last 4 to 6 months, August to September, October, November, December, January, right? we believe that 4.5 to 5 month period will be much more volatile, and it will be market up, vol up again, something we haven't seen in a while. But for the meantime, again, the next 1.5 to 2 months, we believe that we'll start to see, we'll continue to see vol compression and a grind higher, which is a very different distribution of the market and should be played quite differently. How do we think you should be positioning in this market? Still long dated calls, even though we're not getting market up, vol up. The difference is you really want to be funding those calls with everything else, meaning sell short duration puts, sell short duration calls. What is short duration? Something that is a month to 2 months out, right? That will do well in a grind higher, so more positioned to short put than long call. We do not think you should be short much stock, if any, against those long calls. And definitely leaning long delta into this type of a market. So expect at some point, though, like I said, those vols to go higher, particularly in the back of the curve. We're starting to see that a little bit in the short term here as well. That probably means that in the next week or two, we get some sideways digestion to down movement. We believe that move down will lead to market down, vol down in this current environment. Any move down in this environment should be vol compressing, whereas the moves up now should continue to be calendar expansion. And again, that is why we think short puts, long calendar call spreads are the best part of the distribution to play long delta with. From a macro perspective, nothing really new to report, other than that CPI has been a bit softer. Employment numbers, despite being relatively firm, continue to come in less hot. And so we believe there's a lot of signs that the slowing is actually happening under the hood, but that actually is a positive thing in this period because it will lead to more excuse for stimulus. The next big question that we need to address is not just the next 2 months or into the end of the year, because again, that feels fairly, we feel fairly strongly about will continue to be a positive trend, slower for now, a bit more volatile, and potentially more blow-off toppy at the end of the year. But the bigger question is, what is it going to look like at the end of the year, going into the in and out of the election? There's a big event vol there. And what is it going to look like early next year? And that is a big, harder question. The good news is, even if we continue to rally, we believe that period will be very volatile. And so easier to play hedges with a long vol exposure in that environment, especially after what's been a very low vol environment recently, and represents an opportunity. We think that the potential of a Trump presidency could be the new thing that pushes break-evens higher, that drives things like gold higher after a bit of digestion and a shaking of over-positioning in it in the short term. We also believe, other than break-evens, that commodities themselves will start to do better in that period. Particularly, the trade again there is to sell puts, whether it's in energy or copper or other industrial commodities. Short put in those entities, and long calls, longer dated in gold. We believe in dollar strength. That will be a significant continued trend in what we're seeing. We believe that we should be spending more and more money on defense and other government spending vehicles. Even though Biden has been very, very fiscal policy heavy, we believe a Trump administration, ironically, will be even more so. Similar to the logic that it would take Nixon to go open up China, somebody like Nixon to do that, somebody that was hardline and nobody ever thought would. We believe that despite the fear about tariffs and early on a lot of the pressure on tariffs, eventually Trump could be actually the one to help normalize relationships, the relationship with China a bit relative to where we were as we get into later in the year. we can question whether that's a good thing or not, and get into all kinds of questions about big picture and whether that's right or not. But a deal there, we believe, could open the door for another positive move after a decline that we think will come early to mid next year. And again, that target date for that would be mid-January to mid-February. So we believe there are those two windows, again, similar to what we thought this year. With this rally, though, we believe that those are the windows for the most risk, especially now that we're seeing this rally that we've seen. And if we see weakness in those periods, it could be a very ugly decline, a big one, bigger than we've seen since 2020. But that could eventually be remedied in the form of Trump trying to make a deal with China. Anyway, those are the things to be mindful of. The other thing that we've yet to talk about is if we cannot, if Trump does not get elected, first of all, very dangerous for kind of a confrontation we believe that'll come next year between China and the U.S. And if Trump can't make a deal with China, we believe that China eventually will also move on Taiwan as early as next November. So that, and I'll leave you with this kind of thought, would be potentially the scariest thing for equity markets if that seems like it might be possible. Why? Much scarier than it would have been a year or two ago, not just because of the rally in equities, but how the rally has transpired. I urge you to think about what would happen to NVIDIA if China invades Taiwan. The reason the AI hype had not taken hold and why NVIDIA stock was not doing so well about 2 years ago, right, before this massive rally, is because of the fears around China and Taiwan. We've all but forgotten or stopped talking about that, despite at the time us saying that was likely a 2 to 3 to 4 year event. Well, guess what? It's been 2 years. That is something I would urge people to think about. We believe there's a 50-50 coin flip that it happens in the next several years. And if it does, again, massive risk for NVIDIA in particular, and urge you to think about what that would mean for the S&P 500 now that NVIDIA is the biggest stock, or at least one of the biggest two stocks in the whole world. Again, not to fearmonger, we believe, again, that this end of the year will be a very positive period, in particular, slow grind, easy rally here through August, through the middle of August. And then after that, more volatile, still potentially dangerous, but likely volatile and up-moving blow-off top type squeeze in the market that we believe will begin to fade at the end of the year and into early January with some type of blow-off top. So anyway, wishing you the best. Be water. In this period, water tends to mean be near the beach more than anything. But really, hang in there with that long exposure, and as we've urged the last several months through August, and enjoy your summertime. Take care. Bye.
This does not constitute an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or any other product or service by KAI or any other third party, regardless of whether such security, product, or service is referenced in this video. Furthermore, nothing in this video is intended to provide tax, legal, or investment advice, and nothing in this video should be construed as a recommendation to buy, sell, or hold any investment or security, or to engage in any investment strategy or transaction. KAI does not represent that the securities, products, or services discussed in this video are suitable for any particular investor. You are solely responsible for determining whether any investment strategy, security, or related transaction is appropriate for you based based on your personal investment objectives, financial circumstances, and risk tolerance. You should consult your business advisor, attorney, or tax and accounting advisor regarding your specific business, legal, or tax situation.